welcome to the Bias Quarterly Market Briefing, November 2013. This is Robert Pearies and the Portfolio Management team broadcasting to you via the internet from our boardroom in Hamilton, Bermuda. I have with me today on the panel Mr. Mark Melvin, FCCA and Chartered Financial Analyst, Dan Rivera, Chartered Financial Analyst, Deborah Meacock, Chartered Financial Analyst, as well as myself. Now, it's been about 6 months since we've done a briefing, and so we want to update you on what's been going on with capital markets. You see that the data that we have in the slide presentation is as of November 13. And if you go to the next slide, you'll see that growth is positive, but inflation is benign. So that's an ideal environment for global stock markets because we do want gross domestic product to grow in order for companies to be profitable. And at the same time, the fact that inflation is under control means that interest rates don't have to go up. There's no pressure on the Fed to raise interest rates, and that means that companies can finance their ventures at lower rates of interest. The asset classes have had a very good performance on the equity sector. So you see that the S&P Global 1200, that's the 1,200 largest companies around the globe, was up 21.19% year-to-date to November 13. The best performing market, though, was the U.S. market, which was up 26.22% as represented by the 500 largest companies in the U.S. Europe has played catch-up during recent months and is up 21.05% year-to-date. And the FTSE 100, that's the UK 100 largest stocks, was up 15.9%. Note that emerging markets year-to-date have been down 3.65%, and that the U.S. Treasury bond and corporate bond indices are fairly close to zero in terms of performance. So the performance in your portfolios have been primarily and really entirely from your exposure to equities. So really, it'd be true to say that it's all about stocks. Global stock markets, and in particular the U.S. markets, have performed really well, as you've seen in the recent slides. And corporate profitability has remained robust. Now, on the next slide, you'll see that in terms of the movement of the stock price over time, the S&P being the best performer, the Europe tracker coming next, and the global all-cap index following behind. But there's a big gap. You look below at the purple line, you'll see that the emerging markets have not performed as well. Here we have an index of the Asia Pacific Index, which is modestly up on the year, but nowhere near as much as what we've seen in the major industrial Western economies. At the same time, the greenback, or the US dollar, is in a recovery mode. So the ECB recently cut EZ rates, European zone rates, to 0.25% in response to lower inflation figures. And of course, interest rates in the near term do have an effect on the currency, and that allowed the US dollar to respond positively. At the same time, we're seeing solid job numbers come out of the US. On the yield curve side, we see that U.S. Treasury yields have moved up over the last few months, and whereas you might have seen the 30-year yielding 3%, it's now yielding closer to 4%. So now that has an impact in terms of your bond prices. So on the next slide, we compare the impact of various increases in interest rates on both the 5-year Treasury and on the 10-year Treasury. So the 5-year is the purple bar, and the 10-year is the maroon-colored bar. And you see that a 50 basis point increase in in yields causes both of these to fall about 3.9%. A 100 basis point increase it will cause these fixed income securities to fall 5.64% for the 5-year note and 7.6% for the 10-year note. Now, as you go out to higher hikes in interest rates, you'll see that the 10-year is affected increasingly worse than the 5-year for rises in interest rates. So what this tells us is that in order to keep your portfolio immune from the vagaries of rising interest rates and falling bond prices, we need to keep the maturities of your bond holdings fairly short. So this sort of malaise or this lack of performance on the bond side has really encouraged a rotation, which we term the Great Rotation, out of fixed income securities and into equities. So the next chart shows how there has been an increase of money going into equity funds as opposed to fixed income securities. So that indicates that investors are willing to take more risk in the pursuit of higher returns. So the answer is clear. Going forward, we believe that bonds will be a drag on portfolio performance, but we still need to include them in your portfolio in order to provide stability, because even though the prospects for bonds are not as good as equities, they will never be as volatile as equities. So we want to hold bonds just to keep some sort of stability in the portfolio for capital preservation purposes. So we'll avoid those long maturities or structured products, and certainly those fixed income securities with lower credit quality. And we'll have a preference for shorter dated treasuries, even though they provide virtually no return, because that will give you greater assurance of capital preservation. And really only equities provide potential return going forward. And we are looking from these equities not only growth but also income. But certainly any exposure to equities will have a bias towards growth as the economy improves. So, Dan, you're the equity person. Tell us about what's been going on in equity markets in terms of the specific regions and what you see from the technical data is likely to happen in the future.
Sure, Robert. Well, clearly, as you explained earlier, the U.S. equity markets in general, but the U.S. in particular, has had a really great run. And with respect to the United States, the next chart that you're taking a look at not only shows the price advance of the S&P 500 so far, but it also shows on the lower chart a measurement of investor sentiment. Now, most of the time, this line stays pretty much between the green and the red. But in this particular case, it is broken up through the red line, which indicates a certain level of complacency around investor expectations that U.S. stock prices in particular will continue to rise. We think that that sets us up for perhaps a small correction, but we don't believe it will be particularly onerous one. If you go to the next page, one of the reasons we think we might have a pause in the United States in particular is how the momentum seems to be just flattening out a little bit. As you can see from the lower chart, although price momentum is slowing the U.S. with lower and shorter periods of strength that denotes a certain amount of profit taking, it's moderated a bit, but certainly there's no cause for alarm. The U.S. markets are still very sound and very healthy.
So what we see from the momentum bar charts that are in the middle of this graph is that the momentum is sort of plateaued. That doesn't indicate that there's going to be a sell-off, because if you look earlier in this momentum chart, the sell-offs are usually concurrent with a drop in the momentum bar charts, and we're not seeing that. We're seeing a plateau. So we could see some modest growth from here. It's just that we're not likely to see the rapid rises that we've seen in recent months.
Right. We are in what appears to be a solid uptrending market as opposed to one that recovers with a sharp spurt higher.
What about Europe?
Well, Europe has been trying to play catch up most recently, and it has begun to get somewhat weaker. The up periods are longer than the down periods, and in recent times of greater strength, you can see that they tend to be somewhat sharper. That's more a market that indicates recovery spikes, but they also seem to be improving. We think we should stay neutral for the moment as momentum declines, but it'll give us an opportunity to capture returns in that market in the future.
Right, so it's been in catch-up. We were long Europe for a while, but we went back to neutral a few weeks ago, and that's probably the best place to be for the time being until we see momentum turning up.
That's what our analysis indicates. That's correct.
Okay.
And then finally, one of the reasons that gives us some optimism around the Eurozone is you can see that the economic sentiment indicators beginning to rise, and GDP expectations or expectations for GDP growth are much better. And there is even evidence that what have been euphemistically called the pigs, the peripheral nations like Spain, Greece, Portugal, will see positive GDP growth in 2014, which certainly gives all of us a bit of an optimistic outlook for better gains in Eurozone equity markets.
So what about emerging markets?
Well, emerging markets clearly are the linchpin of growth in the world. You can see, looking at this particular chart, the light blue line indicates what portion of world GDP growth is accounted for by emerging markets, and it's clearly 2/3, with a much smaller component coming from the developed markets. The EM market still leads the way, but developed market prospects are improving because there's a clear uptrend in the dark blue portion of the line showing developed markets are improving in general. So nevertheless, EM still drives, emerging markets still drives GDP growth, but the developed markets are improving also.
So if that's from your chart. It's forecasts actually for 2013, 14, and 15.
Well, that's correct. And you can see certainly that it looks like the bottom in the developed market GDP growth was 2013. But at this particular point, emerging markets are really messy. Just on a very simple technical indicator, you'll see 3 lines on this chart, one green, one red, and one purple. The green one is a 50-day moving average. The purple one is a 100-day moving average, and the red one is the 200-day. And these are important because what you want to do before you really commit to an overweight anywhere regionally is you want to see not only the 50-day moving average moving up through the 200-day, indicating things should be improving, but you want to see that same cross from the 100-day. There's a lot of euphemisms for this particular technical event, but when the 100-day moving average finally crosses above the 200-day, that has generally signaled a reason to be optimistic and also a reason to consider an overweight in the arena. We're just not there yet.
I see also that the momentum indicator in the middle of this slide is negative.
That's correct, it is. And that's why we want to wait for confirmation of the 100-day crossing the 200-day before we make a commitment.
Well, let's talk about where we see some of the best opportunities. And I'm going to turn it over to Mark to talk to us about new tech versus old tech.
Thanks, Robert. It's an interesting concept because when we talk about new tech versus old tech, you always think that technology, in fact, is a new cutting-edge industry anyway. But the likes of Intel and Microsoft are very mature companies and are often considered to be an old tech, whereas the new cutting-edge companies are the ones doing the new fancy things. Steve Jobs makes a great point, though, that the overall point about things is that new technology will not necessarily replace old technology, but it will date it by definition. Eventually it will replace it. But it's like people who had black and white TVs when color came out. They eventually decided whether or not the new technology was actually worth the investment. So what we took a look at more than anything else, what are the greatest disruptors in technology at the moment?
And so now can you just, before you go any further, can you explain what a disruptor is?
Disruptors are those things which change the established order. In terms of technology, it is those new cutting-edge technologies, for want of a better word, that come in and shake things up to such a point that what went on before can never happen again, and the new thing is going to be the thing that is going to drive technology forward going forward. One of the nicest things that you can take as an analogy is the mobile phone. Before we had one, I don't believe anyone realized they actually needed one, but now I don't think anyone could do without one. And so it is going forward with these new major disruptors that we see coming down the road. The probably major one of which is mobile computing, mobile being computing in all its manner of ways, not only telephones, but in the way we do our computing, but through our handheld devices. Cloud computing as well, and the combination of the two are the growth in those particular regions are causing PC sales and obviously desktop sales to fall. But the interesting thing is the total number of devices, i.e. all the things like PCs, desktop, laptops, mobile equipment, are expected to rise as users adapt to smartphones and tablets in particular. And by 2017, the expectations are that something along the lines of 2.6 billion devices will ship in that year alone, which is double last year, 2012, a staggering increase. The next chart basically shows how mobile is taking a bite out of PCs. The line going up is of the actual PC itself, which shows a nice measured growth, but the last couple of years and mobile have seen a staggering increase in devices being shipped.
So, but this blue line is all devices, not just mobile, or?
No, that's PCs.
PCs.
That's PCs.
That
okay.
is PCs, just PCs.
All right.
The mobile devices are those which are in the bars below, the Androids, the iPhones, and the tablets. And the interesting thing to me is that how larger majority of the mobile devices are actually Android-driven. And interesting enough, obviously the Android-driven devices tend to be potentially lower cost and lower margin than the
And Android is owned by Google, which is one of our stock holdings.
It absolutely is, yes. And they made that free. It's open source software. Mobile computing is big. It's a very big industry. It's a $1.6 trillion industry, we calculated. And that's excluding the impact of the big four companies, Apple, Intel, Microsoft, and Google. If you add those people in, the industry itself would be over $2 trillion. The interesting thing about this entire industry is that smartphones have now bridged two previously separate industries, wireless networks and personal computing, such that they've now merged and blurred, and that's as a result, the market is so much larger now than it was. Could just throw some statistics in there. In 2012, mobile operators served 3.2 billion customers, so that's probably just about half the population of the world, and that generated 1.2 trillion in revenues for the telephone companies, one of which is one of our favourite picks, AT&T. And the mobile device sector, just to give some more statistics, outsold PCs in dollar terms by 304 billion to 248 billion. And again, that excluded the impact of the big four companies, Apple, Intel, Microsoft, and Google. Factor those in, and the outsized sales over PCs would be that much larger. And if you again want to put a few more statistics in it, 5 times as many handsets were sold in 2012 than PCs, 1.7 billion to be precise, versus 354 million PCs. And it's interesting that 66 million iPads, that's iPads, not tablets of any sort, but Apple iPads, were also sold in 2012. And the next slide just shows the level of what this will translate into, and it comes down to traffic. Ericsson did a survey fairly recently which suggested that global smartphone traffic will increase by tenfold into 2019. And going from left to right, we're looking at 1.9 billion subscribers with smartphones right now, rising to 5.6 billion, which is the majority of the population by 2019. And monthly traffic of 600 megabytes, of traffic, to 2.2 gigabytes of traffic. And the final slide shows the actual total monthly smartphone traffic going from 1 exabyte, which is thousands more than gigabytes, to 10 exabytes per month, which provides your tenfold increase in traffic.
So can you just give us a rundown of all these different types of bytes? Because I think they're getting beyond where we can comprehend anymore.
That's a good one. Thank you for asking that question.
The first one, 1.9
billion people, and 5.6 billion subscriptions, which is going to rise to. So that's 1.9 billion right now, rising to 5.6 billion people. The next one is megabytes. Now, megabytes are 1,000 bytes. And 1,000 times a megabyte is a gigabyte. And then you go up from 1,000 times a gigabyte, then you get something else in between, then it's a terabyte, and then it goes to something else, and then you reach the exabyte.
Exabyte. So what this is showing is this huge exponential
Absolutely.
growth.
It's thousandth of power
in
6.
the demand for mobile use, or in this case, smartphone use.
Smartphone use, data traffic.
Right.
Because obviously mobiles and smartphones, their primary use is not only just making telephone calls, it is data. Data, data, data.
So the growth is huge to the point that it's almost incomprehensible how much this area is going to grow. And of course, as portfolio managers buying equities, we want to be where that growth is in order to provide profits and growth to our clients' portfolios.
That is correct. And across all sectors as well. It's not only the makers of the handsets, it's not only the distributors of the bandwidth and the actual data enablers, but it's also the content providers and what the smartphones are going to be used for. And the next slide shows that very nicely. What are smartphones going to be used for? Well, currently, about half of our activities on Netflix or YouTube, with surfing the net being at 9.74%, iTunes there at just over 3%, Amazon's on 1.6%, Facebook's in there at 1.3%, and a mass of other things as well. I'm assuming Twitter is included in the other. And as a result, in this particular category, where we own are stocks Netflix, Apple, Amazon, and Google, who own YouTube.
So this is really driving demand for another service. I mean, all this mobile, computing, accessing the internet, on the run as we're running from house to office, jumping in the car, picking the kids up in school. There's now starting to put these things into the dashboard of cars. So that creates a demand for another service.
That's correct. That's a simple answer to that one is the cloud. Smartphones are basically small mini computers, and what they do not have is they do not have the ability to store stuff. So you need to have the ability to store stuff, and that has to be somewhere remote, and that's where the cloud came in. And so we see that the cloud is going to be a very big growth area as well within this particular sector. And the next slide was showing the size of the sector plus the potential growth rates in this survey done by Gartner, one of the largest technology forecasting companies. They're suggesting that the industry, which is currently a $131 billion industry, will achieve a compound aggregate growth rate of around about 17.7% up until 2016, and will become a $210 billion industry. So it's nearly doubling in size over the next 3 years. And in terms of where this money will be spent, that's an interesting one. There's 6 major categories: cloud management and security, where earlier this year we bought a couple of stocks, Checkpoint and Fortinet. We now have sold Fortinet out at a profit. They're the small sliver of $10 billion at the top. The next category is cloud system infrastructure services, which, amazingly enough, includes Amazon as the largest provider of remote server farms in the world, something that people don't really realize. Cloud application infrastructure services is also included in that, as well as cloud application services and business process services. But the single largest area is cloud advertising, and which by 2016 is estimated to reach $95 billion. And that kind of company who's involved in that is people like Facebook, LinkedIn, Twitter, Google, and Amazon themselves again.
Okay, so that's old tech versus new tech, and as you can see, our portfolios are well positioned to benefit from this huge growth in both mobile access to the internet as well as to the growing demand for this remote storage of data, otherwise known as the cloud. So, at Bios, we're always looking for the next new frontier. And so I'm going to pass over to Debbie here because she's done some research on an area called life science tools, which is having a huge impact on medicine and healthcare, and we believe creates some exciting opportunities for our clients in the future.
Thank you, Robert. This is actually an exceptionally exciting emerging field within healthcare. It is growing very rapidly. And I'd like to offer a few definitions before I talk about it, just so we all understand what's happening here. Life sciences, first of all, is the study of living things, plants, animals, humans. Life science tools are analyzers or instruments that use special solutions to run tests, to verify if there are any problems or solutions for them. There's a subcategory within this field, which is relatively new, called genetic sequencing, and that's one of the probably most exciting areas. And in order to give you a little background on that, we're going to step back in time and talk about a very important project that led the way for this exciting work to happen. So that very important event that occurred that laid the groundwork for this cutting-edge technology to advance was the Human Genome Project. This provided the initial draft of the human DNA sequence in 2001. It was produced by 23 collaborating laboratories. It took 13 years of work, and it cost approximately $23 billion. If we move forward 12 years to today, using what's referred to as next generation sequencing, one lab can sequence the entire human genome in a few days at a cost of only a few $1,000s. Huge advance. Life science tools are becoming an extremely important tool to identify diseases and treatments for them, particularly the area of life science tools that does the genetic sequencing. So, looking at the next slide, one could say literally being able to understand the gene pool you came from, knowing your family background, could one day save your life. How is genetic sequencing used? What areas does it apply to? One very interesting area is the ability to test the probability that a particular drug or treatment will actually be effective for you. I do know in the area of breast cancer that women that have the HER2 gene get a particular product that is effective there and maybe would be given a different drug if they didn't have that gene. So it leads to more effective treatment. Another thing that's particularly interesting is the ability to understand the susceptibility you as an individual may have to develop a particular disease. And this comes from looking at, indeed, your genes that would indicate a very high ability or susceptibility to have that disease expressed. This would be true for running a test for someone who had no symptoms yet at all. The other area in which genetic sequencing is used is in the diagnosis of abnormal cells. Typically, that's used for diagnosis of various types of cancer. I find it very interesting that in some very rare and unfortunately difficult diseases, that an individual needs to receive one gene for that disease from each of their parents. And in some families, there's an awareness of a prevalence of a particular difficult disease. Parents can each be tested using gene sequencing to see if they have that gene and could possibly each pass it along to a child who would then have the expression of the disease.
So I guess what's so exciting about this area is, a term that I've developed in trying to explain this area is personalized medicine. The fact that the more you know about your genetic makeup, the more you're able, or the more the medical profession is able, as a result of this growing area, to develop more precise treatments to deal with cancers or to assist you in avoiding the carry of genetic weaknesses onto the next generation. Of course, that raises a whole area of ethics and discussions there, but it does create amazing opportunities for improving the success of medical treatment. One of the criticisms of Western medicine is that it's really designed for treating symptoms rather than prevention. So this area of life science tools gets into an area that should be more constructive in terms of preserving and prolonging life in the future.
I think that's particularly true because many treatments for serious diseases actually take a great toll on the individual. And it's unfortunate to go through that if you could know in advance a greater probability of its success.
So So there are other applications for this technology.
Right, and some of them are very interesting in their own. Gene sequencing is used today in forensic sciences. For example, there are individuals who've been put in prison for being told that they had committed a crime. And now that we have the ability to check some of the DNA information that was in the original evidence, tests have been run, and they find out that, in fact, the wrong person was put in jail. And there are a number of people who have been let out of jail not having to finish the rest of their sentence because they really were innocent, and that's pretty powerful stuff. It can be used to determine the father of a child when the father is unknown. Checking the genetic makeup of the child can indicate the father. It's very interesting to determine your own or your family member's genealogical history. Recent news talks about Native American genes now tied back to Euro-Asians. I think it's very interesting. There are many industrial applications for gene sequencing, particularly in the area of environment, checking to see what sort of living organisms are in water or in various natural environments. It's used in the agricultural business to develop disease-resistant seeds for perhaps fruits and vegetables that might transport more easily. So there are many other applications in many other industries. The next slide, why invest in this area now? What makes it so particularly exciting at the moment? When large pharmaceutical companies develop drugs and they receive a patent, that patent lasts for 17 years exclusively. And at this moment in time, we have many major drugs have just recently hit their expiration or are about to. And unfortunately, the major drug companies do not have very productive pipelines of new products coming through. As an example, Merck just cut their R&D budget for this year and next year. What is happening, and is partially happening specifically because of the development of gene sequencing, is biotech companies have much fuller pipelines. They're using these tools to find new treatments to diseases that had been untreated before. One I like to refer to is a new treatment for macular degeneration. The product is called Eylea, and it's developed by Regeneron, which is a biotech company. So lots of new treatments being found in different ways using new tools. The life science tool market today is approximately $40 billion, and in 3 years it's expected to double to $80 billion. So clearly there's enormous growth, and there's great opportunity for innovation of treatment. It's a space with a great deal of merger and acquisitions going on between companies, because some of the companies that have older equipment, older meaning more standard, are looking for some of this new cutting-edge genetic sequencing technology to put in their lineup. We have not found a creation ETF that's been created to replicate this industry, and therefore we have chosen to invest in one particular company.
Well, that last point, though, is interesting because should they create an ETF, that could create more demand for stocks in the life sciences tool area, which is, I don't think, has really caught the attention of the market as a whole. There's been good performance in this subsector, but there's probably a lot more to come as people become more aware of what's happening here.
Exactly. The company that Bias has recently positioned in both the equity fund and the balance fund is Thermo Fisher Scientific. This is a large, well-diversified company that has grown by acquisition and after acquisition, and many times they've cut back businesses that aren't as successful for them. They are a leading provider of the instruments and solutions used in the life science field. They provide to many end markets all around the globe in drug discovery, medical research, academic research, industrial applications, definitely selling into the biotech area where many emerging treatments are being developed, into agriculture and environmental applications. And one of their greatest areas of strength right now is research being done in emerging markets such as China and Brazil. In the last quarter, they reported actually a 20% growth rate of revenues, which is fabulous. But all of that's very interesting, but the piece that made it exceptionally interesting to us is they have completed the terms of an acquisition to buy a major competitor called Life. Life is positioned in the gene sequencing area. So Thermo Fisher Scientific will now provide a broad array of life science tools, but have specific exposure to the fast-growing genetic sequencing space. It's an exceptionally stable business model. The company, after the acquisition, approximately 70% of their revenues are going to come from the consumable solutions that have to be purchased to use in the instruments. So the instruments are only themselves 30% of revenues, and that creates a really strong reoccurring stream of revenues for a steady business model, which we find very attractive.
Well, thanks, Debbie. I mean, I think this last area is particularly exciting, and I look forward to learning more about this particular area. So to those of you that are listening from various locations around the globe, we thank you for tuning in via the internet to our most recent quarterly market briefing. We'll be back to you in due course with our next briefing. Until then, it's Robert Pearies and the portfolio management team at Bias. That's Mark Melvin, Dan Rivera, and Deborah Meacock. And we look forward to seeing you again. Please don't hesitate to contact your account executive if you want clarification on any of the topics discussed in this briefing, and certainly you can come through to any one of the speakers in today's panels. Thank you and all the best.